How you doing today, Nick?
Doing great, Dave. How are you?
I'm doing fine. You ready to record another episode of our podcast?
Yes, I am. Let's do
All
this.
right. All right. So our topic for today, and this is a good one for early in the year, is understanding required minimum distributions.
Yeah, that's right. Or the infamous RMD.
Yes, RMD, as we tend to jingoize everything in this business, don't we?
That's right.
So required minimum distributions and what they are in general is when you get into your 70s, the IRS requires you to start taking money from your traditional investment individual retirement accounts.
Yep. So your 403Bs, 401Ks, or IRAs, and there's some different rules through for each of those that we'll kind of go through. But kind of the principle behind it too, Dave, is basically you haven't paid taxes on any of this money, and so
Right.
the IRS says, hey, we need to get some tax revenue in here at some point. So you've reached a certain age, and now you got to start taking it out so that you have to pay taxes on this distribution, so that we can start collecting some of that revenue that you put off when you were younger and working.
Yeah, yeah. And like everything that involves the government, it's way more complicated than it needs to be.
Absolutely.
So, what we're going to try to do today is demystify it a little bit. And so, we'll kind of start with the ages around which when you have to start taking required minimum distributions, which changed just last year. And it's another one of those things where I spent 20 years of my career learning the rules just so they could go and change them on me.
Yeah,
But
exactly.
we'll
And
adapt.
that's right.
So it was always 70 and a half. Once you reach the age 70 and a half, you had to start taking required minimum distributions. And then in 2018, the law changed and they moved it out to age 72.
Yeah, so part of the CARES Act was that change where it delayed it for a couple more years, and thankfully we actually got a nice round number, not a half year, so that's kind of helpful too.
Yeah, yeah, yeah. But then, of course, because they moved it out 2 years, there's that little vague gray area. Like, what if I turned 70 and a half in the middle there? And so the way the IRS set up the rules is if you were born before July 1st, 1949, you need to start by age 70 and a half. And of course, you'd already be 71 if you were born in 1949.
Right.
And if you were born after June 30th, 1949, you can wait till you're 72.
Exactly. So not quite too easy, especially if you fall into those brackets. But that's the way it's written right now. So 70 and a half for a small select few lucky people, and then 72 for everyone else.
Yeah, unlucky people actually
Yeah.
for the way most of them see it. I
Yes.
was talking to a client just the other day because it's January here and we're calculating out what required minimums are going to be for this year. And she was born on June 24th, 1949. So she falls into the old rules and has to take a minimum this year, whether she wants to or not.
Yeah. 6 days, huh? That's
Yeah,
rough.
6 days. Yep, yep. So, um, so that'll all be simpler too here in a couple of years. It'll just be everybody who's 72 will need to start.
Right.
Another point of confusion around required minimum distributions has to do with when you take them and when they have to be done by. And it's confusing because there's one rule for your first year, and going forward, then there's a different set of rules. And then that first year, they give you a grace period where you can actually wait until up till April 1st of the following year.
Right. Yep. Not to be confused with your tax deadline, which is typically April 15th, April
Right.
1st.
Right. But then every year after that, you have to take your required minimum distribution by December 31st of that year.
Right.
Yeah. So that first year you do have that 4 month grace period, but then after that you've got to have it done by December 31st of the following year of that year. Excuse me.
Right, and then in grace period in some respects, but in other aspects of it, if you do delay until April 1st or January, February, or March for that matter, you have to take two distributions in that year. So that kind of compounds issues as well.
Right, right. If you wait till April 1st, you're going to have to take the previous year, your first year's distribution, plus that current year's distribution needs to be done by December 31st. So if you're trying to mitigate how much money you take during a given year, you end up doubling up your income in that year.
Yeah, so definitely some planning and some thought that has to go behind whether or not you really want to delay into the following year. I would say the majority of people, that's not a good idea, but there are
Yeah.
some cases where we're trying to push off income, and once we
Yes.
start taking RMDs, we can't help it. So sometimes that does work out in your favor.
Yeah, yeah. For instance, if you were still working in that year and had earned income the year you turned 72, you might want to wait till April of the following year to take that year's, because maybe your overall income is lower, even though you're doubling up your
Right,
required minimums.
right.
So the next point of confusion is how required minimums are actually calculated. And when I talk to people who are not there yet, who are younger than that, they have it in their head that the required minimum is going to be this huge number that there's just no way they can wrap their heads around taking it.
Sure.
It's usually not as bad as people expect. At least that's been my experience.
Yeah, and as far as calculations go, it's probably one of the easier ones that the IRS throws out there that you could do. So there is that benefit.
So the way that a required minimum is calculated, you take your December 31st account value for the preceding year, and then you need to pull out a table from the IRS. And for most retirees, the table to use is called the Uniform Life Table. And you can find it online. And we'll have links to this stuff on the article that goes with this. But on that table, then you look up your age, and there'll be a factor, a distribution factor, that you then take that December 31st account value and divide it by that amount, by that factor on the table. And that will tell you what your distribution is.
Yep.
So there are other tables for certain situations. Most retirees are going to use that Uniform Life Table, but if you are a retiree whose spouse is your sole beneficiary and your spouse is 10 years younger than you are, you can use a table called the Joint Life and Last Survivor Table.
Yeah, so kind of actually a benefit there of having a younger spouse as your sole beneficiary, because that table, the factors are a little bit lower in terms of your actual RMD if you have a younger spouse. So that's kind of something beneficial.
Yeah, and the logic behind that is that what the IRS is really trying to allow you to do is spread these distributions over your lifetime. And if you're a married couple with a big age discrepancy, they need to account for that to make it last longer. So the required minimums are smaller. That's in a nutshell. There's also a different table if you are the beneficiary of an IRA that wasn't your spouse's. If you're a non-spouse beneficiary of an IRA, that sounds a little more succinct, then you would use a table called the Single Life Expectancy Table.
Right. Yep. Also different set of rules around that to again expand it out over your lifetime if you're the non-spouse beneficiary.
Right, and those rules all change too, and that's a whole nother podcast to talk about inherited IRAs. But when we talk about that life expectancy table being used for inherited IRAs, we're talking about IRAs that were inherited before 2019.
Right. Yep. So the rules changed along with that as well. And one point I'd like to make here too, Dave, is a lot of times people assume that, you're taking a required minimum distribution, which is essentially you're taking money out of your IRA or 401k. And the assumption is that, and the reason it's stretched out over your lifetime by this percentage is so that you only have to take out a certain amount each year. But that doesn't necessarily mean you have to spend it. And I think a lot of times because of the way it's set up, people assume that, okay, I have to take this out. That means I have to spend it. And that's not necessary. That's not the case. All you have to do is pay the taxes. So
Right.
I know
Right.
there's some confusion around that. I just wanted to kind of clear that up a little bit. You don't have to spend it. You could put it in a different account. You just have to pay the taxes on it.
Yeah. We do have clients who will take their required minimum distribution out of their IRA. We withhold the taxes, and then we turn around and invest that money in a different account. The big thing is that those taxes get paid.
Absolutely.
So I put together an example calculation because I think it will maybe help people understand this a little bit. So in my example, if you're 72 years old and your IRA balance on December 31st of last year was $100,000, and your spouse is, we'll just say for simplicity's sake, is the same age as you are, then on that IRS table, the distribution period factor would be 25.6.
Mm-hmm.
And so your required minimum distribution would be $100,000 divided by 25.6, which gives you a required minimum distribution of $3,906.25.
Yeah, so not a huge amount, in that, shade under 4%
4%.
range.
Yep.
But it's like I said, not a huge amount, but something to give you an idea of what that looks like. And then I think the other thing to be said, you're starting at around that 4% range, but you're also going up every year. So by the time you reach, mid 80s, it's around the 6-7% range, somewhere in that area.
Yes.
If you're lucky enough to live to 120, which is what that table goes out to, I think it's like a third or half,
Right.
just under 40% of your distribution or of your total amount. So you'll never actually run out of required minimum distributions because it's kind of based on a percentage the way that it's set up. But that percentage will get larger every year.
Yep. And so some things to consider when we talk about required minimums. We've already mentioned this one, but it's generally best to take that first year's required minimum distribution in that first year rather than waiting until the following April, even though you're allowed to. But again, that's a planning consideration to talk about.
Yeah, great rule of thumb, but definitely something that you want to actually run some numbers and look at the taxes before you make that decision.
Yeah, and then the next thing to keep in mind, we went through the tables and we went through that example to give you an idea of how it's done, but we would never ask anybody to go out and figure out their required minimum distribution. And even if you're a do-it-yourself investor at Vanguard or Schwab or somewhere, they're going to put that on your statement. They will calculate it in January and figure out what it is for you.
Yeah, they're required as custodians to provide you with that amount.
Right.
So don't feel like you have to do it on your own.
Right. I'd like to say everybody needs us to figure it out for them, but it's not true. Yeah. So the other thing too is they will usually start bugging you in the fall if you haven't taken your required minimum distribution during the year. Most custodians will send out a letter saying, hey, it's August and you still have to take X from your IRA this year, please contact us. Something to that effect.
Yeah, and it's just kind of as a best practice, what we do with a lot of clients or what we recommend that makes sense is you can always set it up to come out in like December automatically so that it's going to come out. But if you need it earlier than that, you can change it. So at least if something happens in December, you get busy, you get sick, you're out of the country, who knows? It's going to come out, so you're not going to have to pay that 50% penalty because that is the largest penalty that the IRS levies is this failure to take out a certain amount of money from your IRA.
Yep. That was my next point to talk about is the penalty is pretty steep. It's 50% of whatever you didn't take. So you want to make sure you get it done.
Yeah, absolutely. And if if you're sitting here at 74 and you haven't done it, what I would tell you from experience is report yourself to the IRS because they're usually much more forgiving of these things if you self-report than if you just try to forget it because eventually they'll find it.
Yeah. There is a mechanism to correct it if it especially if it was an administrative oversight, and that happens. A form doesn't get processed, something goes wrong. I've seen it a couple times and never had a client actually have to pay the the penalty, but
Right.
usually it requires, a letter of acknowledgement to the IRS saying, hey, this happened, here's what we're doing to remedy it, which usually is taking the distribution right away and withholding the taxes. And that usually takes care of it, but you don't want to have to do that. So,
right, absolutely.
So, it's funny, people get hung up on the number from the required minimum distribution, but it's just that, it's a minimum.
Mm-hmm.
And we generally want to advise people to take the least amount possible from an IRA during the year, but you've got to take what you need to live on. So, right. So the required minimum is just to make sure you hit those thresholds that the IRS is getting the taxes that they expect. And of course, it is taxable as income. So you're going to get a 1099-R in February of the following year that shows what your gross distributions were for the year to make sure that you did as directed. And custodians can always withhold taxes too from the distribution. For most of our clients, we'll talk to them about where they're likely to fall for their marginal tax rate for the year, or we'll collaborate with their tax advisor. And when we process the required minimum distribution, just like a paycheck, a certain amount will get withheld and sent straight to tax withholding. And then that is reported on that 1099-R. So when you file your taxes for that year, it gets squared up.
Yeah, absolutely. And another thing to bring up here too, Dave, is just the planning that goes behind some of this. And this is probably a whole nother podcast, but something to think about if you're sitting there with a pretty sizable IRA and you've got 10 years until you hit 72 or 15 years. There's some things that you're going to want to think about if you're not planning on taking distributions, because just because you're not taking distributions now, knowing that you have to take them and trying to project what that amount will be and trying to figure out if that's going to affect you from a tax standpoint is pretty important, because you can do things early on, but the longer you wait, the harder it is to make changes or to make any significant changes that will affect your required minimum distribution at 72. So something to definitely think about and talk with your advisor about making sure you're aware of what that's going to look like. Right.
It's easy to fall into the trap of trying to minimize your taxes in the particular year you're in. But when you step back and take a big picture strategic view, what you really want to do is pay the least amount of taxes over your lifetime, not just in any given year. And so, what Nick's getting at there is if you just delay until you have to take required minimums, sometimes those required minimums have grown so large that they create a tax problem on their own. That if you had started taking some money out or doing Roth conversions or doing different things in your 60s, you may have been better off overall. So.
Yeah, and it's very inflexible too, right? Once you get to that 72, there's nothing, at that point you have to take it out. You really run out of options if you wait until that point. So not to say that doing something earlier is right for everyone, but it's certainly better to look at it earlier than it is to wait until it's too late.
As with most things, that's why they call it planning, right?
Exactly.
So
why Dave and I have jobs.
Yep, job security. Amen. So another question that comes up pretty often is, how do I have to take it, right? And the IRS doesn't care. As long as that 1099 that you get for that year shows that you took out at least the required minimum. We have folks who take it monthly. We have folks who take it as a lump sum once a year. I've got snowbirds who like to take it in May when they get to their place for the summer and take the rest of it in November, or, they'll split it up into a couple pieces. I've got folks who take a set amount every month, and then once a year we take out extra to make sure they've hit the minimum. There's no perfect formula for that. It's whatever works for you for cash flow.
Yeah, so it's definitely, your comfort level and how you're going to utilize those funds and what makes the most sense to you. The important thing is making sure you get the right amount out by the deadline, but how you get it out doesn't necessarily matter as much.
Right. And
One other consideration on that too is if you have multiple IRAs, you don't have to take it from each of them. You can
Right.
figure out what that amount is from each IRA, and then you can take that all out of one IRA.
Yeah.
So that's something
Yeah.
else from a planning perspective. If you have multiple IRAs, if you have different investments in them,
Yeah.
you can kind of play that game of what makes the most sense.
Right, right. Sometimes there'll be assets in one IRA that it makes more sense to utilize in a particular year than a different one, and so we might add those together and take the entire required minimum from one or the other. Along those lines, though, so at the beginning you mentioned that these rules apply to 401ks and 403bs as well. You can aggregate all of your IRAs as one group and take the required minimum from one, but you can't mix 401ks and IRAs, and so
Right.
it can be a little bit more complicated.
Yeah, and along those lines, we talked about 401ks, 403bs, but if you have an active 401k and you're still working, you do not have to take a required minimum distribution from that. So be aware of that as well if you're
Right.
working later on
Yeah,
in life.
You could be 75 and covered by your company's 401k plan and not have to take a required minimum distribution unless you're a 5% owner or more of the company.
Yep.
Kind of a gotcha there that
exactly.
So yeah.
Always something in the background.
Yep, always something, always something. But yeah, this is one of those topics that comes up very often in financial planning and with pre-retirees that are wondering how this works. So I hope this took some of the mystery out of it.
Yeah, definitely, a good recap on kind of the basics and the main points that we talked about. Make sure you know how much to take out and make sure you take it out in time because the penalties are steep. And rely on your custodian to calculate that for you. It's not something you have to do on your own. And then think about, well before you hit 72, if you're going to have problems, you want to start kind of thinking about those things and making plans sooner rather than later if you can.
Yep. Sounds good. So we'll also have those tables in the example on our website on the article that goes with this podcast if you're interested.
Absolutely. And as always, if you have questions or if you want to talk over planning for RMDs, feel free to reach out and give us a call.
All right. Well, thank you, Nick.
Always a pleasure, Dave.
Thanks.